Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description.
Here, we're talking about the introduction to industry and company analysis. So we're zooming out a little bit from the last module, which was the intro to equity securities. Here, key two topics. One is Porter's Five Forces, which is basically a framework that can be used to identify how competitive an industry is. And there's basically five different factors that go into this analysis. One is the threat of entry, so the threat of new companies entering the market. Two, the threat of substitutes, so the threat of some other product, maybe in a different industry even, being used as a substitute for the product or service that you're selling. And then three and four are related, but a little bit different, just like the flip side, right? So the power of buyers, so the power of people, like the end customers of the product, how much leverage and negotiating power they have with companies. And then on the other side of that is the power of suppliers. So especially if like the company is selling a product, and there's only a couple suppliers that actually provide like the raw materials or the product or can build it or whatever, then these suppliers are gonna have a lot of negotiating power, right? So in both of these, power of buyers and suppliers, it's like a your typical demand supply equation. The more buyers there are here, the less negotiating power they're going to have, and in the same case here, the more suppliers in an industry, the less negotiating power each of them is going to have. But overall, these four factors all combined to create the rivalry or level of competition within an industry. So this framework is, it's pretty much always mentioned in like business school and your economics readings and all that. In practice, it like no one really lays out their company or industry analysis using like these subheadings and organizes it in a way that follows this framework to a T. But nonetheless, all of these factors are definitely top of mind to analysts when they're looking in an industry. So moving on, we're also going to talk about the industry life cycle and the five different stages of the industry life cycle. So this is a little bit different than the business cycle or economic cycle. We're going to go over these in some detail. We have a chart from the curriculum that we'll pull up and describe each of these. But key thing here is that we need to think of like not an economy as a whole. Think of like a new product being launched and how at the very, at the time of its invention, it's going to go through some different phases and then it eventually gets like the mature phase and then hopefully not, but it might go to the decline phase as well. And then each of these different stages are going to have some different characteristics regarding competition, pricing, profits, all that. So with that, let's jump into the questions.
Which of the following is least likely to involve industry analysis? A sector rotation strategy, B, top-down fundamental investing, or C, tactical asset allocation strategy? Answer is C, tactical asset allocation, because this strategy deals with taking advantage of timing of investments within asset classes. So like investing in different or overweighting or underweighting different stocks in like energy or in financials or something like that. Sector rotation is more related to timing investments in industry as a whole. So at like a very high level, you might um, overweight a like consumer staples ETF or make private equity investments in consumer staples at different times of the business cycle. And then top down fundamental investing. Top down, of course, you start with macro views. So, factors such as GDP, forecasts, inflation, interest rates, stuff like that. And then from there, from these macro factors, you decide which industries are going to be most attractive over the next over the next certain time frame. And then from there, you're going to go down and within industries and you look at individual companies. And bottom up, of course, is just the opposite, where you start with individual company um, analysis first, and bottom up analysis usually is more based on fundamental investing or relative value or something like that. And then next, a sector rotation strategy involves investing in a sector by A, making regular investments to it. No, I kind of just mentioned that it's used to time investments to take advantage of the business cycle. So it's not making regular investments, or else that would just be, just like if you were even weighted across a bunch of different industries, there wouldn't be a rotation if you were just making regular investments. Which of the following factors would most likely be a limitation of applying business cycle analysis to global industry analysis? A, some industries are relatively insensitive to the business cycle. I mean, like sure, but it's kind of a blanket statement, like not really as relevant to the question in my opinion, so we'll just keep it on hold. B, correlations of security returns between different world markets are relatively low. No, they're relatively high for the most part, so this is incorrect. And then C, one region or country of the world may experience a recession while another region experiences expansion. Yeah, so this is true, right? So if you're looking at business cycles, so like your expansion phase, your contraction phase, all that on a global basis, you might oversimplify a little bit because there's some countries, maybe like in a developing country or on the other side of the world, they might actually be having a really good year while in North America or Europe, economic growth might not be as good. Which of the following statements about peer groups is most accurate? A, constructing a peer group for a company follows a standardized process. No, it's pretty subjective. There's not, a standardized process. And maybe a quick summary on what a peer group is. Basically, if you're looking to um, compare the valuation of a company to similar competitors, you might, like, let's say we have, let's do like Walmart. And we want to look at Walmart's stock price and see if it's multiples. So it's like EV to EBITDA, or it's like price to earnings or something like that. You want to see if these ratios are high, above average, low, or like in line with competition. So you would construct a data set that has a peer group that might include like Costco. Honestly, can't think of that many other big large retailers like Target. I don't think Target's public though. But you see where I'm getting at here. You just construct a list of companies A, B, C, D, and get all of their valuation multiples, and then compare them to Walmart's and come up with a conclusion as to whether or not Walmart is over or undervalued. Of course, this isn't the only piece of the analysis that you would do, but it'll give you a general sense of where Walmart is trading relative to its competitors. So moving back to the question, so peer groups, what's accurate? Commercial industry classification systems often provide a starting point for constructing a peer group. Yeah. So industry classification systems are just basically they're just groups of stocks or companies or operation types that fall into certain categories. So some like general industry classification systems might provide some guidance on whether or not to classify a company as being in like energy or in like tech or consumer staples or whatever, right? So these are usually a pretty good starting point um, to start creating a peer group, but from there you're also gonna have to whittle down your peer group and become more selective based on how similar the operations are of the company that you're considering, how big the other company is, where they operate, like which geographies, all that. So you try to get the most comparable companies as possible. Moving on to the next one, with regard to forming a company's peer group, which of the following statements is not correct? A, comments from the management of the company about competitors are generally not used when selecting the peer group. Yeah, I mean, this isn't going to be true, right? Like if a CEO of Walmart is saying, "Hey, our biggest competitor right now is Costco," what are you going to do? Not include Costco in your analysis? Like, who are you? Who are you to say that, right? So this is not correct right off the bat. Um, but we can make our way down the list here as well.
The higher the proportion of revenues and operating profit of the peer company derived from business activities similar to those of the subject company, the more meaningful the comparison. Yeah, so this is correct, so it's not the answer. Um, it's kind of what I was saying about a little bit earlier, right? You want to have companies with similar operations to make your valuation multiples and your overall comparison more comparable. And then finally, comparing the company's performance measures with those for a potential peer group. Company is of limited value when the companies are exposed to different stages of the business cycle. Yeah, that's true as well. So if they have, they're undergoing different stages of the business cycle, maybe there's a company um, in the US and then there's one in like Europe and they both have similar operations. So here you go, like Tesco. There you go. See? I can remember another one. Um, yeah, so if you have like the Walmart of Europe and then Europe's undergoing a recession and America's booming, then it's probably your comparison is probably going to have some faults to it for sure. An industry that most likely has both high barriers to entry and high barriers to exit. So, capital investment required to start and then the time it takes to wind down operations. So which one of these industries has that? Restaurant industry, I mean, it does, but we got to compare relative to our options, right? So restaurant industry, keep it on hold. Advertising industry, like not really. Um, you could start a social media advertising company with like pretty much nothing. So cross that one out. Automobile industry. Okay, so it's definitely going to be the automobile industry. Like think about the big players. You got your GM, you got your Tesla, you got your Ford, all those guys. They've been around for so long. They have all these facilities set up. Um, they've been advertising forever. I mean, Tesla doesn't advertise, I guess, but they've been around for so long, and they have all the tech, they have all the facilities, all the people, the brand awareness. So for someone to just come in and compete, it's there's going to be a lot of cost and time associated with that. And then high barriers to exit also, like GM just can't just like wind down all its factories, right? Like it's gonna have to do something to exit. Like I honestly can't really see how any of these companies would fully exit. Like in my opinion, they would have to just sell out to a strategic buyer. So automobile is the answer. Here, before we go into the next question, I just wanted to quickly steal this chart from the curriculum, and it outlines 5 different industry cycles, 5 different stages of the industry cycle. And this is different than the business cycle that we saw for general economy previously. That would have been in the economics topic, right? But here we're dealing with the stages of an industry. So if you think, um, you can kind of use, like, I'll use HD TVs as an example here. So at the very beginning, when HD TVs first got created and first started getting sold, we're in the embryonic stage. So it's, at the very early stages of the industry. It's going to have slow growth, high prices, and significant investment to actually create these. So like back in the day, these TVs were, I don't even know how much, a lot of money. And now you can get a 60-inch 4K TV for pretty cheap, right? Relative to like the worst TVs that were like 10 years ago. And these TVs were like 10 times worse and probably double the price, right? Um, but then from there you go into the growth phase where profitability starts picking up, production improves, prices start to fall, and then demand's increasing. And then the shakeout phase really is meant to weed out any of the um, poor companies or the companies that aren't competing well. And then some leaders emerge. Growth starts to slow a little bit, but that's only because there was so much rapid growth here. And then we get to the mature phase, which is where we are now with HDTVs. Eh, I mean, it's classified as little or no growth here. HDTVs might not be the perfect example of that, but generally, it's mature phase. Growth is relatively relatively stagnant. Usually grows in line with GDP growth. That's usually like when a lot of companies are determined to be in a mature industry. When analysts are forecasting, typically like you'll model revenue growth at GDP growth, and that's kind of conservative, but that's kind of best practice. And then you also have consolidation. So big players are buying smaller players, and you're gonna have like, you know, three, four, five, six big players, and that's it, and high barriers to entry. And then at the very end, you have the decline phase where growth starts to decline. There's excess capacity, not as much demand anymore. Still high competition, but at this point, they're kind of fighting to survive more than anything else. So with that, we can come back to the question. Which of the following life cycle phases is typically characterized by high prices? Well, that's what I said. The HGTV is a perfect example, embryonic phase. Next, in which of the following life cycle phases are price wars most likely to be absent? Um, yeah, I mean, I would have just from the answers here, I would have put embryonic. Um, you can't really compete on price when like your products at the very beginning cost so much to produce, and you're one of a couple producers, right? So I would have put embryonic, but just based on the answers here, embryonic's not here, right? So I would put C, the growth phase, where prices are starting to fall a little bit, but the price wars mainly occur here in the mature phase and the decline phase when people are trying to just get whatever sales they can. If over a long period of time a country's average level of educational accomplishments increases, this development would most likely lead to the country's amount of income spent on consumers' discretionary goods too. Well, if you get if you have more people completing education, so like university, all that, the thought here is that they'll make more money, which then they will spend on consumer discretionary goods. So discretionary goods are just that. You know, they're up to the spend on them is up to the discretion of the consumer. So these might be like luxury goods such as like nice cars, like watches, stuff like that. Um, Stuff that you don't really need on a day-to-day basis versus consumer staples. So consumer, this industry classification is your like grocery and your everyday necessities like your toiletries, all that. Um, so yeah, education goes up, money goes up, spent on consumer discretionary goes up. With respect to competitive strategy, a company with a successful cost leadership strategy is most likely characterized by a low cost of capital, reduced market share, or the ability to offer products at higher prices than those of its competitors. Well, right here you can cross this out. If they're successful at managing their costs, they have a really low cost base, they can offer products at lower prices. So this one's wrong. Um, Reduced market share, not necessarily. Like it, you don't know enough here. Just because they have low cost doesn't mean they're not a market leader. Um, but in the event that they have low cost, it is likely that they're going to have a low cost of capital. Um, you know, you can kind of extrapolate this a little bit. So if the company's really good at managing their costs for the same amount of revenue, they're going to have more capacity to take on more debt. Um, and the idea that the probability of bankruptcy is a little bit lower. So due to that, debt holders especially are going to require lower interest rates on their investments. And then equity investors, of course, it's equity is more expensive than debt, but if a company, once again, is successful at managing its costs and can generate the revenue, then it's not going to be as risky of an investment, and therefore they don't require such a high required rate of return. When conducting a company analysis, the analysis of demand for a company's product is least likely to consider the company's cost structure. Yeah, well, demand for the company's product doesn't really have anything to do with the company's cost structure. You could like really stretch the thinking here and say, okay, their cost implies, you know, what price they charge, and the price they charge impacts demand, but that's, you know, kind of thinking a bit too much here. They don't mention anything about price or anything like that. So they're kind of, you know, mentioning these factors in isolation. So we could even go down the list and you would see that this is the best answer here. So motivations of the customer base, of course, are going to be an important part in demand for a product. That's not the answer. And then the differentiating characteristics, of course, are important as well. So this is, definitely A is definitely the best answer. Which of the following statements about company analysis is most accurate? A, the complexity of spreadsheet modeling ensures precise forecast of financial statements. No, absolutely not. Spreadsheets and Excel modeling does get complex in a lot of cases, but many people would actually argue that the more complex and more assumptions in a model, the less reliable the forecast is. So, not not circling that one. Next, the interpretation of financial ratios should focus on comparing the company's results over time, but not with competitors. No, you definitely need to compare with competitors as well. Um, sure, it's a good thing if the company's financials are improving relative to itself over time, but how is that stacking up versus the competition, right? You gotta connect the dots there to see the company's positioning in the market. So C is going to be our answer, but we can read it. The corporate profile would include a description of the company's business, investment activities, governance, and strengths and weaknesses. And yes, this does include all of those, so that's the answer.